Alright, so here we are. The last topic for topic 6, which is the preparation of final account after adjustment. Okay, so for this preparation of final account, okay, unlike the previous preparation of final account, we simply use whatever information given in the trial balance. Alright, but this time around, we have to take into consideration if, okay, there are any adjustments given. Okay, so if you look at this additional information, okay, there are few adjustments given: 1, 2, 3, 4, and 5. Okay, so we need to prepare the adjusting entry. Okay, and I'm going to use a past exam question of October 2016. So in question, it is common that there will be a trial balance, okay, with additional information. So as we look at just now, there are, as we look at the question just now, there are 5 adjustment, 5 additional information, okay, that we have to prepare, that we have to consider, okay, that we have to take into account before we prepare the final accounts, which are statement of financial position and statement of profit or loss. Okay, so let's look at one by one. Okay, so I'm going to start with the first one. All right, so if we look at the first one, all right, so if we look at the first one, okay, there is an inventory. Okay, there is an inventory of, okay, there is an inventory as at 30th June 2016, okay, which valued at 12,000. Okay, so what are these? All right, so this inventory of 12,000, okay, is the inventory at the end of the year. And the amount of inventory that you see in the trial balance as at 1st January 2015, okay, this one is referring to the opening inventory. Okay, so for inventory at the beginning of the year, okay, this one will be disclosed in cost of sale. All right, this one also will be disclosed in cost of sale as well as current asset in the statement of financial position. Okay, all right. Okay, all right, so let's put some note here. Okay, so this one will be shown in cost of sale as well as current asset. Okay, all right, and then let's look at number 2. So this is also cost of sale. Okay, maybe I should reduce the size. Okay, next. Okay, next additional information is related to where the owner took 450 goods for his personal use. Okay, the owner took 450 goods for his personal use. Okay, so whenever the owner took something from the business, this is a drawing. And this will reduce the owner equity. Therefore, we are going to debit the owner's equity account, which is drawing account. All right, so debit drawing 450 and credit. Okay, then we look at the transaction again. Okay, what are the items took by the owner? Is it a cash or goods? All right, so in this case, the owner took goods. All right, so goods meaning we have to reduce the purchase account. So when we reduce purchase account, we credit purchase account. Why? Because purchase is an expense account. So to reduce an expense account, you credit. So here we are going to credit purchase account, okay, by 450. So how this affect the existing balances in the trial balance? Okay, for drawing, debit drawing meaning that you are going to add to existing drawing account, this one. Okay, so 560 plus 450. Okay, so new amount would equal to Okay, 1010. Okay, all right. Next, purchase. You credit purchase. So if you refer here, okay, so you have here purchase and sale. Okay, so this is 75,600. Okay, this amount. Okay, this is purchase. Okay, because purchase is an expense account. All right, and an expense account usually has a debit balance. Okay, has a debit balance. All right. Okay, so that is a purchase. Okay, and then what about 150,000? Okay, 150,000 is sales. Because why? Because okay, because sales is a revenue account. So revenue account, okay, it is common for revenue account to have, okay, to have credit balance. Okay, I hope you still remember, okay, our discussion in the previous topic. Okay, all right. So is it clear? Okay, so now there will be an adjustment to the purchase account. Okay, where we have to deduct, okay, 450 from purchase account. So this working is for purchase account. Okay. 75,600 minus 450, meaning that the new balance here should be 75,150. Okay. All right. For purchases. Okay. There will be no more 75,600. Okay. All right. Next. Okay. So bad debt. All right. Bad debt of 1,200 has to be written off. Okay. It is the policy of the firm to provide 5% allowance for doubtful debt on the remaining account receivable. Okay. So let's settle, okay, this one by one. Okay, so first we prepare the adjusting entry for bad debt. All right. Okay, so we prepare the adjusting entry for bad debt. All right. So what would be the adjusting entry for bad debt? Okay, it will be debit allowance for doubtful debt of 1,200, and then you are going to credit account receivable. Okay, so I put it as AR, account receivable, 1,200. Okay, meaning that from this transaction, okay, from this transaction, the adjustment would be to debit allowance for doubtful debt. Okay, so look at here. Allowance for doubtful debt is the opposite to account receivable. Okay, it reduce account receivable. Account receivable is an asset account. So account receivable will have a debit balance. Allowance for doubtful debt, okay, will reduce account receivable. So the balance for allowance for doubtful debt is credit balance. Okay, so when you decide to debit, okay, when you prepare adjusting entry, and the adjusting entry is to debit allowance for doubtful debt, meaning that, okay, meaning that you are going to deduct from the existing balance of 1,200 minus, okay, 1,200. Right? So I stop at 1,200 first. Okay? All right. And then what about the account receivable? So for account receivable, okay, we have to credit, meaning that, okay, account receivable, okay, this one. So account receivable and account payable. Again, then you have to choose which one is account receivable and which one is account payable. Okay. So account receivable is an asset account. So for asset account, okay, for asset account, we have debit balance. Okay, we have debit balance, meaning that, all right, this is for account receivable. All right. Okay, that's it. Whereas for Okay. All right. Whereas for account payable, okay, account payable is a liability account. All right. So liability account usually have a credit balance. Okay. So this is for account payable. Okay. All right. Okay. So let me adjust first this one. Okay. Should be okay, right? Okay, so for this transaction, yeah, for this adjusting entry to credit account receivable, meaning that I'm going to take that 30,000 ringgit, okay, minus, this is for account receivable, yeah? Alright, so 30,000 ringgit minus bad debt of 1,200. Okay, alright, so that's it for the adjusting entry for bad debt. Alright, then we need to continue. It is a policy of the firm to provide 5% allowance for doubtful debt on the remaining account receivable. Remaining account receivable meaning that after we made an adjustment to the account receivable, which is this one, okay, 30,000 minus 1,200. That will be your remaining account receivable. Okay, so we are going to calculate allowance for doubtful debt, okay, for at the end of the year. Okay, so allowance for doubtful debt. So this is for the balance CD of allowance for doubtful debt. Okay, so it will be equal to 5, is it 5%? Yes, 5% multiplied with the existing balance. Right, so 30,000 minus 1,200 is equal to, should be 28,000. Yes, 28,800. Okay, so this should be 28,800. Okay, so the answer is 1,440. Alright, so 1,440. Okay, so 1,440, meaning that, okay, if we refer here, the allowance for doubtful debt, after we adjust for bad debt, all right, what happened to the allowance for doubtful debt is that we have a zero balance. But at the end of the year, okay, we should record, okay, allowance for doubtful debt of 1,440, because this is what we calculate here is the closing balance for allowance for doubtful debt, okay, which we should replace, okay, the allowance for doubtful debt at the beginning of the year. Okay, so the amount in the trial balance should be the balance at the end of the year. All right, not the balance at the beginning of the year for allowance for doubtful debt. All right, so we should replace that with 1,440. Okay, so to get this 1,440, okay, meaning that here, okay, so this is the previous, okay, example. Okay, so 0. So this is the from the opening balance. Okay, so meaning that we have to add, okay, to increase this amount. Okay, we need to increase this 0 to 1,440, because that is the balance at the end of the year. Okay, so to increase that, meaning that we have to add, okay, we have to add, okay, 1,440. Okay, so another way to do this one is, okay, number one is for you to recognize that allowance for doubtful debt at the end of the year is 1,440. So we're going to write it here. All right, and then, okay, and then this we are going to replace as a closing balance. Okay, this will be your closing balance. Okay. No longer an opening balance. All right. Okay, another way to calculate is, all right, so number one, okay, you are going to replace allowance for doubtful debt here with 1440. And allowance for doubtful debt is to reduce account receivable. So you take this amount and you replace it here. Okay, so there will be no 1,200. Right? Okay, but you cannot simply replace that amount. You have to do some adjustment. So what would be the adjustment here is for you to recognize, okay, if there is any, okay, because of the difference here. Okay, as you can see that, okay, there is a difference between the opening and closing. And then for the opening, after you deduct the adjusting entry for bad debt, what happen is it equal to 0. But you have to show it here as 1440, not 0. Alright, so you have to do some adjustment here. Okay, you have to add. So whenever you add something, whenever you reduce something, you have to prepare the adjusting entry. So what is the adjusting entry here? Okay, the adjusting entry here is, okay, you have to prepare, okay, the adjusting entry. The difference is to be called as doubtful debt. Okay, so if we are going to use the formula, all right, so I'm going to show you a formula here as the formula that I have explained in the previous slide. Okay, how to calculate the doubtful debt. Okay, so doubtful debt is equal to closing balance, okay, that you have identified above, 1440. All right, plus if you have any bad debt, all right, 1,200, and then you minus with if there is any opening balance. Yes, in this case, the original opening balance is 1,200. All right, but we want to replace that with 1440. Okay, so okay, so I'm going to continue this one. All right, so minus the opening balance, which is 1,200. So there will be a doubtful debt to be recognized, okay, which is the difference between opening balance, closing balance after you adjust for bad debt. All right, so equal to 1440. If it is a positive, what did I say previously? This is an increase. So when there is an increase to the balance of allowance for doubtful debt, that will be considered as an expense in your statement of profit or loss. Okay. Okay. So to be exact, it is to be called as operating. It is to be put under operating expense. Okay. All right. So I hope you understand here. So if I were to show you a journal entry, the journal entry would be, because this is an increase and you have to increase your AFDD account. All right. Okay. So when we increase our AFDD account, we are going to credit AFDD. Okay. So to debit, meaning to debit doubtful debt. Okay. So doubtful debt. All right. Of the difference. Okay. 1440. And then to credit AFDD 1440. Okay, so basically we are doing the same thing. Okay, we are doing the same thing. So you may use either way, okay, whichever that you understand. All right, so if you want to stick to the note, okay, that we have go through together, okay, that we have went through together before, okay, so you may refer to the previous slide, which is this one. Okay, when you have a bad debt, okay, what should you do? All right, how to calculate that? How to calculate whether if there is any increase or decrease in doubtful debt. All right, so this is the formula. Okay, down here. All right, so down here you have the formula. So if you use this formula, okay, it will be easier for you to identify whether there is an increase or decrease to doubtful debt. All right, okay. So we have finished, I think, with adjustment 1, adjustment 2, and adjustment 3. Okay. All right. So what are we going to do with this doubtful debt? All right, do we have a doubtful debt account previously in the trial balance? If you go through one by one, okay, you may not see any doubtful debt here. All right, meaning that, okay, if I were to re-prepare my trial balance, meaning I'm going to add this doubtful debt to the trial balance. Okay, but before that, let me cancel few items. Okay, so this one you have to replace with the, sorry. Okay, so this one you have to replace with the new balance. That one also, this one also. Okay, provided that there is no more adjustment related to drawings related to purchase. All right. Okay, that's it. Sorry, I want to cancel this one. How to cancel? Okay. Okay, settle. Okay. All right, and then account receivable. So account receivable also will be replaced with 22, okay, 28,800. Where should I write that one? Here. This is for account receivable, yeah? Okay, it should be 28,800. Okay. I hope you can see that. And I hope you understand that. I have difficulty moving this around, which I don't know why. Okay, that. Okay, settle. All right. Okay, so meaning we are going to replace account receivable with 28,800. Okay, allowance for doubtful debt with 1440. Purchase with 75150. Drawing with 1,010. Okay, but then there is an adjustment here which is to debit doubtful debt. Right, but we don't have any doubtful debt here. So meaning you have to add. You have to add. All right, doubtful debt. And to debit. So we are going to put it here on the debit side. 1440. Okay. All right. Okay, so have we took into account every adjustment? Yes. So far, yes. Okay, so let's move to adjustment number 4. Okay, so adjustment number 4 is depreciation. Okay, depreciation. So we're going to calculate depreciation for office equipment. So this would equal to, okay, reducing balance method. So 10% multiply with, okay, so reducing balance method meaning cost, okay, 10% on carrying value. So 10% on carrying value. So how much is the carrying value? Cost minus accumulated depreciation for office equipment. So 20,000 minus this amount to 1,000. 20 minus 2. Okay, so 20,000 minus 2. Minus 2,000. Okay, so this equal to 18,000 times 10%. So 1,800. All right. Okay, so for motor vehicle, straight line, 20%, meaning that this equal to 20% on cost. Okay, because it used straight line method. So 20% on cost of motor vehicle. So motor vehicle is 70,000. So times with 70,000, which is equal to 14,000. All right. And the last one, furniture and fitting, also on cost, okay, at 5%. So equal to 5% multiply with, okay, the cost of furniture and fitting. So furniture and fitting is 750. Is it? Did I read correctly? No. Furniture and fitting is 15,000. Sorry. Okay. So equal to 750. Okay. So that would be your adjustment for depreciation. Okay. What would be the adjusting entry? The adjusting entry would be to debit, okay, respective depreciation account. Okay, and then to credit its respective accumulated depreciation account. Okay, all right. So let's do that in the existing trial balance. Okay, number one. Okay, number one is to debit depreciation. Okay, so first look at the trial balance. Do we have any depreciation account here? No. No meaning that you can add new account here. Call depreciation for depreciation for office equipment. Okay, so depreciation for office equipment is how much? Okay, so how much? 1,800. Okay, so put it there as 1,800. Okay, and then proceed to the next one. Depreciation motor vehicle. Okay, of how much? 14,000. Okay, and then depreciation furniture and fitting. Okay, of 750. Okay, all right. Have we finished on this depreciation? No, we haven't finished preparing the adjusting entry for depreciation. We have to update also the balance for the accumulated depreciation. Okay, so this one would be 2,000 plus. Okay, so this one would equal to 2,000 plus the new depreciation, which is 1,800. So this would equal to 3,800. All right. What about this one? 7,000 plus 14,000. So equal to 21,000. Alright, and furniture and fitting, the existing balance is 750 plus this year balance of 750. Alright, so here would equal to 1,500. Okay, settle adjustment number 4. Alright, so we cancel the previous amount, the previous balance. Alright, okay. Next. So next, accruals and prepayment for the period are as follow. Okay, so accruals and prepayment. Accrual meaning that we understate, okay, our we understate or okay our expense or revenue. Okay, our expense or revenue is understated. If it is a prepayment, meaning that our expense or revenue for the year is overstated. So when you prepare the adjusting entry, you have to decide either to add or to minus. Okay, all right. So for accruals, because this represent the amount understated in revenue or expense. Okay, so meaning we are going to add to the respective expense account and also the revenue account. Okay, all right, so let's do that. For utilities, okay, there are an accrued expense of 350. So the journal entry would be, okay, for accrued expense. So I'm going to show you in general. Okay, so for accrued expense, the adjustment would be to debit expense account and to credit accrued expense account. Okay, all right. For accrued income or accrued revenue, okay, the adjustment would be to debit accrued. Oh no, we don't call that as accrued. We call that as income not yet received. All right. Okay, and then we're going to credit income account. Okay, depending on the income. Okay, it could be rental income, it could be interest income, it could be dividend income, or interest received, dividend received. Okay, rental received. Okay, next for prepayment. Okay, prepayment or prepaid expense. Okay, so to debit prepaid expense, meaning that you have overstayed your revenue or expense for the year. So the adjustment would be to debit prepaid expense account but to credit expense account because you have overstayed your expense. So you are going to reduce that. Okay, reduce to the amount of expense that should be incurred for that year only. Okay, what about prepaid, okay, or income received in advance? Okay, for income received in advance, okay, we are going to debit, meaning that we have overstayed our revenue. So we are going to debit income and we are going to credit income received in advance. So the name you have to be specific. Okay, it depends on the type of income. If it is a rental income, then you debit rental income and then you credit rental income received in advance. Okay, so that is only an example. Okay, so now let's focus on the adjusting entry that we have to prepare here. Okay, that we have to prepare here. So the first one is related to utilities. So accrued expense, meaning that you have to debit utilities, credit accrued expense. Debit utilities. Utilities is an expense account. Utilities has a debit balance. Right. So when you debit, meaning that you are going to add. All right, you're going to add another 350 because the balance in the trial balance is understated. All right, so we're going to add 350. Utilities. So I want you to search for utilities. Okay, so here. All right, so to add because you understate. Okay, so we're going to add. All right, so 3850 plus 350. So this would equal to right. So this would equal to Okay, 4,200. So I'm going to replace that with 4,200. All right. Okay. Next. Salaries and wages is understated by 900. Salaries and wages. Okay. 23,000 plus. Okay. Plus how much? 900. Okay, so this would equal to, so we're going to replace this amount, right? So 23,900. Okay, before I forget, right? Okay, for adjustment, okay? So we only debit the expense, but so far we did not credit any accrued expense. So I'm going to do that now. Alright, so just now I have added to the utilities, okay, because utilities are understated. Okay, so by 350, so I add another 350, but because this is an accrued expense, so meaning I have to create new account, because if you go through the trial balance from up to the bottom, all right, so you may find that, okay, from capital, okay, to the carriage outwards, you may not find any accrued expense, accrued utilities recorded yet. All right, so we are going to create that account and we are going to call that as accrued utilities. And the adjustment is on the credit side. So we put it here on the credit side. Okay, so same amount, because that is the adjustment that we have prepared. Okay, so same amount, 350. Similarly for salary, so we're going to add another account called accrued salaries and wages. Okay, so how much did we understate the salaries and wages? 900. Okay, so we're going to put it here as 900. All right. Next. Rental expense understate by 1,000 due to accrued expense. So rental expense 1,000. Rental expense is here. Okay, so originally it is 11,000. Okay, so I'm going to add another 1,000. All right, so here it should equal to 12,000. Right? Okay. Okay, so next. Accrued. Okay, then create an accrued expense account. Don't forget. Okay, so I'm going to continue up here. Accrued rental expense. Okay, of 1,000 credit. Why do I credit? Because that is the journal entry, to debit expense and to credit accrued expense. Okay, all right. And interest on bank loan, okay, is understated by 750. So look again, okay, in our trial balance, do we have any interest on loan? No, we don't have any interest on loan, meaning that you have to add that into your, when you prepare the adjusting entry, meaning that you have to update your account. Okay, all right, so I'm going to add interest on loan. Where should I add interest on loan? Okay, maybe here. So interest on loan of how much? 750. Okay, credit. Sorry, interest on loan, debit. This is an expense account, 750, but an accrued interest on loan is to be credited. All right. Okay, so accrued interest on loan is to we are going to credit accrued interest on loan, meaning that okay, we are going to put that here 750. Okay. And then we do have another one, which is interest on investment. Okay, meaning that the amount of revenue, interest on investment, you have an investment, and at the end of the year you receive interest. So that would be your income, interest on investment. Okay, 1,200. So search for any interest on investment. Do we have any interest on investment account here? Interest. This is investment, but not interest on investment. Okay, there aren't any, so we are going to add. All right. I have no other space, so I'm going to use this space. Interest on investment. I think there is no interest on investment in the list of trial balance yet, so I'm going to add here. Of how much? Okay, so interest on investment is an income account. So we're going to refer to accrued income. So to debit income not yet received, meaning that we're going to create a new account called interest on investment not yet received. All right, and then credit interest on investment, because this is a revenue. So increase in revenue, we have to credit here. Okay, so of 1,200. All right. Oh, what is it? Okay, 1,200 credit. But at the same time, you have to recognize also interest on investment. Okay, not yet received. Okay, I'm using a short form because I don't have much space here. Okay, of how much? 1,200. So to debit, right? 1,200. Okay, right. That's it for the accruals, and then we have prepayments. Okay, so we have insurance. So usually insurance is an expense. Okay, so when there is a prepayment, so refer to prepaid expense, to debit prepaid expense, and then to credit expense, meaning that we are going to deduct from our insurance expense account because we have overstayed this amount by 800. Okay, so search for insurance. Yes, we do have here. Okay, 4,800 minus 800. All right, so the amount here should be equal to 4,000 only. Okay, instead of 4,800. Don't forget to create, okay, prepaid insurance. Okay, where should I add this one? Okay, maybe here. Okay, so I have adjusted insurance. Now I'm going to create new account called prepaid insurance. Okay, same amount but on the different side. So prepaid insurance is to be debited 800. All right, and the last one is commission received overstayed by 500, meaning that you receive income in advance. So we are going to prepare an adjusting entry, which is to debit income, meaning that to reduce our income and to transfer that amount to income received in advance. Okay, so 500. So search for commission. Okay, so we have commission received. Yes, commission received. Okay, so this amount is to be reduced. 2,500 minus 500. Okay, so minus 500. Okay, that's it. So new amount should equal to 2,000 only. Okay, all right, next. That's it. No, Not yet. I have recorded a decrease in commission received due to prepayments. Okay, but still I have to record also commission received in advance. Save in advance. Okay, of 500. All right. So do we debit or credit? Just now we credit, right? We credit. So we are going to put that amount on the credit side of how much? Of 500. Okay. All right. Okay. So basically, all right. So basically, that's all. Okay, for the preparation of final account after adjustment. I mean, for the adjustment. Okay, so you have to prepare for the adjustment. So these are the adjustment that you have prepared so far. You have took into account the drawings. Okay, bad debt, provision or allowance for that food debt. All right, and then you have take into consideration also the number 4, the depreciation. Sorry. Okay, you have calculated also the depreciation. You update, all right, depreciation account, and you update the accumulated depreciation account. And the last adjustment is for accruals and prepayment. So we have adjusted both accounts, all right, both expense or revenue account, and whether we have a prepaid, okay, expense or revenue, or prepaid expense or revenue received in advance. Okay, so once you have add everything, you have adjust, okay, you have adjust the amount in the trial balance. All right, now we are going to use this new list of accounts in the trial balance with their respective, okay, with their respective amount, all right, with their new amount or adjusted amount. All right, then we are going to prepare final accounts. All right, we're going to prepare final accounts. Okay. Okay, so there are workings that I have prepared previously, okay, which is this one. All right. So if you can't see clearly, maybe you may refer here, okay, to the workings that I have prepared previously. All right, and then, okay, here is the, all right, and then I update the trial balance. Okay, so here I show it nicely, but in the final exam, you don't have time to re-prepare or reconstruct the trial balance. All right, this is because I have so much time in hand, so that's why I re-prepare the trial balance. Okay, but during the final exam, the time is very limited, so usually this is how your paper should look like. All right. Okay, you have to you have to scribble on your paper. Okay, it will be messy like this one, but it would help you to prepare you are able to prepare the final accounts after that. Okay, very fast. Okay, all right, because you have updated everything. Okay, so then you have to replace, okay, the balances with the new balance. Okay, so when you transfer, make sure you transfer the new balance. All right. Okay. I think I have updated everything, right? Okay. All right. So usually at the end of the day, this is how your exam paper should look like. All right, where you scribble everything on the paper. All right, and then, okay, and then what happened is we are going to prepare the final account. So you are going to transfer revenue and expense to statement of profit or loss. Okay, and then you are going to prepare a statement of financial position by showing the asset, okay, on the equity, and also the liabilities. All right. Okay, so this would be should be the answer. Okay, so let me reduce the size so that you can see everything together. All right, so that's it. Okay, I just want to focus on the discussion of the adjustment, because once you identify all the items that you have to show in the statement of profit or loss and statement of financial position, all right, then you are able to prepare. Okay, because we are using the same format. Okay, over and over again. All right, so you just follow the format. Okay, and then make sure, okay, your total asset is equal to total equity and liability. All right. Okay, so as usual, if you have any question, please comment. Okay, send me message. Okay, if you want to ask me any question. All right, so that's all for our discussion of topic 6. That's the end of topic 6. Thank you.